Ever dreamt of, building your own thing, your own empire?
Hmm.
Maybe you've got that side hustle that's starting to feel, well, a lot more like a real business.
Happens all the time.
Or maybe you're just super curious about how all the financial and legal gears actually turn when you take that leap.
It can seem pretty daunting from the outside.
Well, you are definitely in the right place. Today, we're diving deep into that sometimes intimidating but honestly fascinating world of financial and legal stuff for your business.
Yeah, it's crucial stuff.
Think of this as your shortcut. We want you to be really well informed about the key tax and legal bits, help you sidestep those common traps, make smarter choices right from day one.
Exactly. We're going to unpack some, let's say, dense material, but we'll make it easy to follow.
Understandable, memorable, maybe even a little bit fun.
We can try.
Okay, so let's unpack this first big thing. Imagine Maria starting her dream cookie business. Her very first decision, and yours too, is picking the legal structure. And this isn't just about a cool name, right? It hits everything: taxes, your personal risk.
Absolutely. It's foundational. This choice defines two massive things. Your personal liability, what happens if things go south, and how the business's money is taxed. It's not just paperwork.
Okay, so the simplest one first, sole proprietorship.
Right. Sole proprietorship just means one person owns the business. Dead simple to set up. Often, no formal state filing needed beyond maybe basic local licensing.
That's easy, too easy.
Well, here's the huge implication. Unlimited personal liability.
Uh-oh.
Yeah, that means the owner is the business. If Maria's cookie business gets sued or can't pay its bills, her personal savings, her house, it could all be at risk.
Wow, so no separation at all.
None. Your personal wallet and the business wallet are basically one and the same. That's why a lot of entrepreneurs move away from this pretty quickly as they grow.
Okay, that's a serious reality check. What if Maria brings in a friend? Partnerships.
Right, general partnerships. Two or more people acting as co-owners to make a profit. Like sole props. Often no formal state filing needed to start. The agreement can just be implied by how they act.
But the liability thing, does that change?
It gets even more complicated, actually. Partners are personally liable for all partnership debts and obligations, and that includes contracts or even, say, accidents caused by other partners working for the business.
Wait, even if it wasn't your fault?
Exactly. It's called joint and several liability.
Okay, break that down. Joint and several.
It means creditors can go after any partner for the entire debt of the partnership, not just their share. So if Maria's partner racks up a huge bill, the supplier could potentially sue Maria for the whole amount, hitting her personal assets.
Yikes, that's a massive risk.
It is. It's why written partnership agreements are so important. Quick note, there are variations like LLPs, limited liability partnerships, which offer some protection, and limited partnerships, but those still need one general partner with that unlimited liability.
Okay, so that brings us to a really popular one, especially for smaller businesses starting out, the LLC, Limited Liability Company.
Yes, the LLC. It's structured as a separate legal entity from its owners, who are called members.
Separate entity. So that means...
It means liability protection. Generally, the members are not personally liable for the business's debts and obligations. It creates a sort of shield.
A shield. I like
Yeah.
that. Between your business problems and your personal life.
Precisely. Plus, it offers tax flexibility, often taxed like a partnership or sole proprietorship, avoiding the corporate tax issues we'll get to. Most states even allow single-member LLCs now.
All right, now for the heavyweights. Corporations, C Corp and S Corp. These sound more formal.
They are typically more formal to set up and run. A corporation is a totally distinct legal entity, separate from its owners, the shareholders. It can exist potentially forever, and ownership, the shares, can be easily bought and sold.
Let's start with the C Corp. What's the main thing to know there?
Taxation. It's basically double taxation.
Double. How does that work?
So the C Corp itself pays income tax on its profits. Then, if the corporation distributes some of those profits to shareholders as dividends, the shareholders pay income tax on those dividends again on their personal returns.
Oof. That sounds not great. Why would anyone choose that?
That's the million-dollar question. It's a trade-off. While double taxation isn't ideal for maybe smaller cash flow businesses, C Corp are often the only structure that works for companies aiming for major growth, seeking venture capital, or planning to go public someday.
Ah, so it's about attracting big investment.
Exactly. C Corp offer flexibility with different classes of stock and are what most VCs and public markets understand and require. So you might take a potential tax hit for scalability and fundraising power.
Got it. But then there's the S Corp. It sounds like it tries to fix that double tax problem.
You got it. An S corporation elects for a special tax status. It's a pass-through entity.
Pass through.
Yeah, think of it like a pipe. The business's income, losses, deductions, credits, they all flow through the corporation directly to the shareholder's personal tax returns.
So taxed only once.
Correct. Taxed once at the individual shareholder level, whether or not the money was actually distributed. It avoids that C Corp double taxation layer.
Sounds perfect. Any catches?
There are strict requirements. S Corp are limited, usually to 100 shareholders. Those shareholders generally have to be individuals, certain trusts or estates, no partnerships or corporations typically. Usually only one class of stock is allowed and no foreign shareholders.
Okay, so wrapping up the structure part, the big takeaway for listeners.
It really boils down to this. Your choice here massively impacts your legal protection, that shield we talked about, and your tax bill.
Yeah.
And thinking bigger picture, picking the right structure early on can save you a ton of headaches and potentially a lot of money down the road. It's worth careful thought.
Definitely. Okay, so structure chosen. Now, what about those first costs? Setting things up, buying equipment. How do you handle that investment smartly from a tax perspective?
Great question. This is where you can get some immediate tax benefits. When Maria sets up her cookie shop, she'll have organizational costs.
Like lawyer fees, state filing fees?
Exactly. Legal fees for the charter or bylaws, accounting fees to set up books, state and corporation fees. You can immediately deduct up to $5,000 of these.
Okay, $5,000. And what about startup costs?
Similar deal. Startup costs are things like employee training before opening, initial advertising, market research, investigating the feasibility before you open the doors. Again, you can deduct up to $5,000 these right away.
Two separate $5,000 deductions.
Correct. One for organizational, one for startup. But there's a limit.
Always a limit.
Yeah. Each $5,000 allowance gets reduced, dollar for dollar, if your total costs in that category exceed $50,000.
So if organizational costs were, say, $52,000?
Then your immediate deduction will be reduced by $2,000 down to $3,000. The rest, the amount over the immediate deduction limit, gets amortized.
Amortized, spread out.
Right.
Okay.
Spread out as deductions over 180 months, so 15 years. You still get the deduction, just over a longer time.
Okay. That helps with those initial fees. But what about bigger stuff? Maria needs a huge commercial oven, mixers.
Now we're talking Section 179. This is a really powerful deduction. It lets businesses immediately expense deduct the full cost of a certain amount of qualified business property in the year they buy it and start using it.
What kind of property qualifies?
Mostly tangible personal property. Think machinery, equipment, computers, office furniture, even certain improvements to non-residential buildings like roofs, HVAC systems, security systems.
And how much can you deduct immediately with Section 179?
For 2023, the limit was quite high. $1,160,000.
Wow, over $1 million.
Yep. But again, there's a catch. That deduction amount starts phasing out if you place more than $2,890,000 of property into service during the year.
Okay, so it's aimed more at small to medium businesses.
Generally, yes. Also, the Section 179 deduction can exceed your business's taxable income before taking the deduction. It can reduce income to zero, but it can't create a net loss you can use against other income. And some things don't qualify, like land, intangible assets, or property used less than half the time for business.
So Section 179 lets you write off a lot right away. Is that the end of the story for big purchases?
Not quite. There's also bonus depreciation.
Bonus. Sounds good.
It is. It allows you to deduct an additional percentage of the cost of qualifying new and used property right off the top. For 2023, that percentage was 80%. Though, note that it's phasing down in future years unless Congress changes things.
So you can use both Section 179 and bonus depreciation?
Yes. You apply Section 179 first, up to its limit. Then you apply bonus depreciation to the remaining cost basis. Then, whatever's left gets depreciated using the regular MAM-CRS depreciation schedules over several years.
Okay, let's try a quick example. Say Maria's Cookie Empire buys $3 million in new equipment. How might that work, roughly?
Okay, $3 million in 7-year property in 2023. First, Section 179. The $3 million exceeds the $2.89 threshold, so her $1.16 million allowance is reduced. Let's say after the phase-out, she gets roughly $1,050,000 in Section 179 deduction.
Okay.
That leaves about $1,950,000. Now, bonus depreciation. 80% of that is $1,560,000.
Yeah.
So add those two up. Now she's only got $390,000 left. That remaining amount gets regular depreciation. For 7-year property, first year is about 14.29%, so maybe another $55,000 deduction.
So total first-year deduction is over $2.6 million? on a $3 million purchase.
Exactly. Something like $2,665,000 in deductions in year one. It massively accelerates the tax savings.
That seems incredibly powerful for freeing up cash flow in those early critical years.
It absolutely is.
Yeah.
That's the main strategy. Front load those deductions, reduce your taxable income now, keep more cash in the business to grow.
Is there ever a reason not to take these accelerated deductions?
It's rare for a new business, but technically yes. If you expect your income and therefore your tax rate to be much higher in future years, you might consider spreading the deductions out more using just regular depreciation. But usually, the time value of money makes taking the deductions now the better move. It's a strategy call, often best made with a tax pro.
Right. Okay, so the business is set up, equipment bought, and deductions claimed. Now, the day-to-day running, let's talk income and expenses. What counts as gross income?
Basically, almost everything. All money you receive, obviously. But also the fair market value of property or services you get paid with. Things like bargain purchases from an employer. If you buy something for less than it's worth, the difference can be income. Guaranteed payments to partners. Taxable fringe benefits, like using a company car for personal trips.
Okay.
Even employer contributions to a Roth 401k are included in gross income, unlike traditional 401k.
Huh.
And sometimes employer-paid life insurance premiums over $50,000.
So pretty much anything of value coming in. Is there anything significant that's excluded?
Yes, some important exclusions. Life insurance proceeds paid because someone passed away are generally tax-free. Certain employer benefits like qualified tuition reduction programs, adoption assistance up to a limit, $15,950 for 2023, and dependent care assistance up to $5,000 per household.
Good to know. Now the fun part, expenses. What can Maria deduct for her cookie business on her Schedule C if she's a sole proprietor?
She can deduct ordinary and necessary business expenses. Ordinary means common and accepted in her industry, like, baking supplies. Necessary means helpful and appropriate for the business.
So give me some examples.
Sure. Salaries she pays to employees, not herself. State and local business taxes, office expenses like rent for her kitchen space, supplies, utilities, business travel. Car expenses, either the actual costs or the standard mileage rate. 65.5 cents mile in 2023.
What about meals, taking a supplier out?
Business meals are generally 50% deductible, assuming they meet the criteria like having a business purpose, and of course depreciation on her business assets, like that oven we talked about.
Okay. What are common things people think they can deduct on Schedule C but actually can't?
Good one. Number one, salary paid to the sole proprietor herself.
Right.
That's considered a draw or withdrawal of profit, not an expense. Federal income tax is never deductible as a business expense. The personal portion of mixed-use expenses like personal miles on the business car or personal use of a home office isn't deductible. Charitable contributions go on your personal Schedule A, not the business Schedule C. Health insurance premiums for the sole proprietor are an adjustment to income, not a Schedule C expense.
Right. And speaking of things hitting the owner personally, self-employment tax. This surprises a lot of new entrepreneurs.
It really does. If you're self-employed, you're responsible for both the employee and the employer portions of Social Security and Medicare taxes.
Both halves.
Both halves. That totals 15.3% on your net self-employment earnings, up to the Social Security wage base for that part. It applies if your net profit is $400 or more.
Ouch. That's a big chunk on top of income tax.
It is. The silver lining is you get to deduct 1/2 of the self-employment tax you pay as an adjustment to your gross income. That helps soften the blow a bit, but you definitely need to plan and budget for it. Quarterly estimated payments usually cover this too.
Okay. Now, sometimes people have activities that look like businesses, but maybe aren't quite making money yet. The IRS might call it a hobby. What's the difference, and why does it matter?
This is a huge distinction. To deduct business expenses beyond your business income, the activity must be engaged in for profit. If it's deemed a hobby by the IRS, you still have to report all the income.
But the expenses?
Your deductions are limited. Generally, you can only deduct hobby expenses up to the amount of hobby income. And usually these are miscellaneous itemized deductions, which are harder to take now after recent tax law changes. So if you have a loss, you likely can't deduct it if it's just a hobby.
So how does the IRS decide? Profit motive. What do they look for?
They look at about 9 factors, but the key is whether you're acting in a business-like manner.
Like keeping good records, separate bank account.
Exactly. Do you have a business plan? Are you advertising? Seeking expert advice? Do you actually have expertise in the area? How much time and effort are you putting in? Is there an expectation that assets used might appreciate? What's your history of income or losses? Do you have other substantial income that might suggest this is just for fun?
It sounds like they want to see a genuine effort to make money, not just offset personal enjoyment costs.
Precisely. If it walks like a duck and quacks like a duck, they want to see if it's really trying to be a profitable duck, not just a pet duck. Getting this wrong means potentially losing valuable deductions.
Okay. Another area with specific rules is rental property. If Maria decides to rent out, say, the apartment above her bakery, how does that work for income and loss?
Rental income and expenses are usually reported on Schedule E for individuals. The income is gross income, and you can deduct related expenses, mortgage interest, property taxes, repairs, insurance, depreciation.
What if the expenses are more than the income? A rental loss?
Generally, rental losses are considered passive losses, and passive losses can usually only be deducted against passive income from other sources, like another rental property or a business you don't materially participate in.
So you can't just use rental losses to offset your salary income.
Not automatically. However, there's a big exception. If you are an active participant in the rental activity, meaning you make management decisions like approving tenants, setting rent, approving repairs, you might be able to deduct up to $25,000 of rental losses against your non-passive income, like wages.
Ah, that's helpful for smaller landlords.
It is, but that $25,000 allowance phases out as your adjusted gross income goes up, generally between $100,000 and $150,000.
What about vacation homes? People rent those out but also use them personally. How are expenses handled?
That gets complicated because you have to allocate expenses between rental use and personal use. Let's take Julie's vacation home example. Rented 2 months, used personally 1 month, vacant 9 months. For expenses that accrue evenly over the year, like property taxes and mortgage interest, you allocate based on days rented versus total days in the year, 365. So roughly 365ths of those costs would be allocated to the rental activity.
And the rest is personal.
Right. The portion related to personal use might be deductible on Schedule A as itemized deductions, subject to limitations there.
What about costs like utilities or repairs, things that happen when it's used?
For those operating expenses and depreciation, the allocation is based on days rented versus total days used, rental plus personal. So in Julie's case, it was used for 3 months total. 2 months were rental. So 2/3, 23 of the utilities and depreciation during that usage period would be allocated to the rental activity.
And the key thing is you can't use these allocated expenses, especially depreciation, to create a rental loss if there's significant personal use.
Correct. The deductions can generally only reduce the rental income down to zero in that scenario. Any excess loss might be carried forward. It really highlights how the IRS looks closely at how you use property.
It's fascinating how these categories work. Getting it wrong seems like it could have big tax impacts.
Definitely. Understanding passive versus active, hobby versus business, proper expense allocation, it's crucial.
Okay, Maria's cookie business is booming. She needs help. Time to hire. This opens up a whole new can of worms, right? Responsibilities, taxes.
Absolutely. And the first, most critical distinction is employee versus independent contractor. Getting this wrong is a major pitfall.
What's the core difference the IRS and legal system look at?
Control. How much control does the business owner have over the worker and how they do their job?
Can you expand on that? What does control look like?
Sure. An independent contractor generally uses their own methods, sets their own hours within project deadlines, provides their own tools, is paid by the job, works for multiple clients potentially, and doesn't get employee benefits. Think of hiring a plumber to fix a leak.
Right. You don't tell them how to fix it, just that it needs fixing.
Exactly. An employee, on the other hand, is usually told what to do, how to do it, when to do it. They're often trained by the employer, work set hours, use employer-provided tools, are paid a wage or salary, work primarily for that employer, and receive benefits like health insurance or paid time off.
And why is this classification so incredibly important?
Several huge reasons. First, liability. Under a doctrine called respondeat superior, an employer is generally liable for torts, wrongful acts committed by their employees within the scope of their employment.
Meaning if your employee crashes the delivery van.
The business is likely on the hook. That's generally not the case for an independent contractor. Second, taxes. For employees, you have to withhold income tax, Social Security and Medicare taxes, and pay the employer share, pay unemployment taxes.
None of what you do for an independent contractor, right? They handle their own taxes.
Correct. They get a Form 1099, not a W-2, and they're responsible for their own self-employment taxes. Misclassifying an employee as a contractor to avoid these costs can lead to massive back taxes, penalties, and interest if you get caught, plus potential lawsuits.
Okay, so assuming you have actual employees, what are some key employer responsibilities? You mentioned unemployment tax,
The
FUTA.
FUTA, the Federal Unemployment Tax Act. It funds a state-run system providing unemployment benefits to workers who lose their jobs through no fault of their own.
Who pays this tax?
Only the employer pays a UT tax, not the employee, not self-employed individuals. It's calculated on the first $7,000 of wages paid to each employee per year. The rate is technically 6.0%, but employers get a credit for state unemployment taxes paid, typically up to 5.4%, making the effective federal rate often much lower, like 0.6%.
And who has to pay FUTA? All employers.
Employers generally need to pay if they paid wages of $1,500 or more in any calendar quarter, or if they had one or more employees for at least some part of a day in any 20 or more different weeks during the year.
Got it. What about injuries on the job?
That's workers' compensation insurance. These are state-mandated programs. Employers are required to carry workers' comp insurance to cover medical expenses and lost wages for employees injured on the job.
Does it matter whose fault the injury was?
Generally, no. That's the key feature. Workers' comp is a no-fault system. The employer is strictly liable, meaning automatically responsible, regardless of whether the employer or even the employee was negligent, as long as the injury arose out of and in the course of employment.
So the employee gets benefits relatively easily.
Yes, and in return, the employee generally gives up the right to sue the employer for negligence over that workplace injury. It protects both sides, in theory.
Okay. And the big one these days, health insurance. The Affordable Care Act, or ACA.
Right. The ACA has requirements for both individuals and employers. For businesses, the main thing to know is about applicable large employers, or ALEs.
ALEs, who are they?
Generally, businesses with 50 or more full-time equivalent employees. ALEs are required to offer affordable, minimum value health coverage to their full-time employees and their dependents. Or else they face potentially significant penalties, often called the employer shared responsibility payments.
What makes the coverage affordable?
Affordability is based on the employee's cost for the lowest cost, self-only coverage offered by the employer. That cost generally can't exceed a certain percentage of the employee's household income, around 9.5%, though the exact figure adjusts slightly each year.
And if an ALE doesn't comply those penalties, are they deductible?
No, that's important. ACA penalties paid by employers are not tax deductible.
So, bringing it all together for someone building a team, what's the core message?
It's about compliance and risk management. Understand the employee versus contractor difference. Budget for payroll taxes like FUTA and workers' comp. And if you're growing towards that 50-employee mark, get ready for the ACA requirements. These aren't just suggestions, they're legal obligations with real financial consequences.
Absolutely. Okay, RIA's business is running, team is in place, things are going well, but you still have to deal with the overarching tax system. Deadlines, payments, maybe getting help.
Right. Let's talk compliance basics. First, deadlines. For most individuals, including sole proprietors filing Schedule C, S-Corp shareholders, partners, the main tax filing deadline is April 15th.
Unless it falls on a weekend or holiday, then it shifts.
Correct.
What if you just can't get it done by then? Can you get an extension?
Yes, easily. You can file Form 4868 by April 15th for an automatic 6-month extension to file your return, pushing the deadline to October 15th.
6 more months. Great.
But and this is a huge, but it's an extension to file, not an extension to pay.
Ah, so the money is still due when?
Your estimated tax payment for the year is still due by the original April 15th deadline. If you owe money and don't pay it by April 15th, you'll likely owe interest and potentially penalties, even if you got the filing extension.
Good distinction. And you mentioned estimated taxes. People need to pay throughout the year, right? Not just in April.
Exactly. The U.S. has a pay-as-you-go system. If you're self-employed or have other income without withholding, you generally need to make quarterly estimated tax payments, typically April 15th, June 15th, September 15th, and January 15th of the next year.
What happens if you don't pay enough through the year?
You can face an underpayment penalty. This usually applies if you owe $1,000 or more when you file your return and didn't pay enough tax throughout the year via withholding or estimated payments.
How do you avoid that penalty? Are there, targets to hit?
Yes, there are safe harbors. You generally avoid the penalty if your payments during the year equal at least 1. 90% of the tax you owe for the current year, or 2. 100% of the tax shown on your prior year's return, assuming that return covered a full 12 months.
So you can base it on last year's tax.
Yes, that's often the easiest way.
Yeah.
Though there's a small tweak. If your adjusted gross income, AGI, in the prior year was over $150,000, you need to pay 110% of the prior year's tax to meet that safe harbor.
Okay, that makes sense. Now, this is all sounding pretty involved. When should a business owner think about getting professional help with taxes?
Honestly, for most businesses, even relatively small ones, getting professional help is often a really good idea right from the start. The rules are complex, constantly changing, and mistakes can be costly.
What should you look for in a tax professional?
Anyone who prepares or assists with tax returns for compensation must have a Preparer Tax Identification Number, or PTIN, from the IRS. Beyond that, look for credentials like CPA, Certified Public Accountant, or EA, Enrolled Agent, experience with businesses like yours, and someone you feel comfortable communicating with.
And these professionals have rules they have to follow too, right? It's not the Wild West.
Absolutely. Practice before the IRS is governed by Treasury Department Circular 230. It sets standards for ethical conduct and competence.
Like what kind of standards?
For example, practitioners must exercise due diligence in preparing returns and advising clients. That means being careful and accurate. They can generally rely on information clients provide, but they can't just ignore things that look wrong or contradictory.
Okay.
They also have to inform clients about potential penalties related to tax positions and ways to potentially avoid them, like through adequate disclosure on the return.
Are there things they're flat out forbidden from doing?
Yes, they can't charge an unconscionable fee, something outrageously high. They absolutely cannot guarantee tax refunds. If someone promises you a specific refund amount before even looking at your details, run away.
Good tip.
And here's a weird one that surprises people. A tax preparer is generally forbidden from endorsing or negotiating a client's refund check, no matter how small. It's a strict rule against handling client funds that way.
Wow, okay. What about confidentiality?
Very important. Tax return preparers are generally prohibited from disclosing any tax return information obtained during the preparation process or using it for any purpose other than preparing the return, unless the client gives explicit written consent, or in very specific legal circumstances like responding to a subpoena or for peer review.
So summing up this part, professional help can be invaluable, but choose carefully, know they have rules to follow, and understand those rules are there to protect you, the taxpayer.
Exactly. A good tax pro is a partner in navigating this complexity, ensuring you're compliant while also helping you take advantage of legitimate tax saving strategies. The regulations ensure a level of accountability,
What a journey we've covered today. Seriously, from that very first choice business structure.
which impacts so much.
Right. Then making smart tax moves with those initial costs using things like Section 179 and bonus depreciation.
Accelerating those savings.
Managing the day-to-day income and expenses, understanding self-employment tax, the hobby versus business line.
And those tricky rental rules.
Then, bringing on a team, the huge employee versus contractor distinction, FUTA, workers' comp, ACA.
Lots of responsibilities there.
And finally, navigating the tax system itself, deadlines, payments, and knowing when and how to work with a professional.
Keeping it all compliant.
This really was meant to be your shortcut, helping you move from just being curious about business finance and tax to feeling, hopefully, much more well-informed.
Yeah, demystifying some of this complex stuff.
So here's a final thought to leave you with. Considering everything we've discussed, the structures, the expenses, the compliance, the team responsibilities, how might the choices you make today in managing your venture, how might they shape not just your immediate bottom line, but the actual long-term legacy you're building?
That's a great question. It's about more than just the numbers, isn't it? It's about the kind of business you want to create.
Definitely something to think about. Every situation is unique, so we really encourage you to reflect on this, maybe dig a little deeper into the areas that affect you most, and absolutely consider getting tailored advice for your specific business journey.
Sound advice.
That's all for this deep dive. Thanks for joining us.